Hello and welcome. My name is Felicity Keras and I'm the Head of Communications at CPI Energy Finance. Today we will present two papers on green finance in China as part of a project supported by the UK PACT Programme. These reports are both available on our website already. First, we will hear from Udetanshu, a principal at CPI Energy Finance, who will be then followed by CPI Energy Finance's Executive Director, David Nelson. We will have time at the end for a short Q&A, but I would ask that you add your questions to the Q&A box that should be visible at the bottom of your screen. And with that, I will hand over to Udetanshu.
Thanks, Felicity. Good morning and good afternoon, everybody. So we start by looking at a quick recap of the importance of green bonds for China. And so China currently represents about 12% of all the global issuance, second only behind US, including offshore issuances. Even in 2019, they issued something like 55.5 billion, and the market has almost tripled since the first issuance started in 2016. And for China to achieve its sustainability targets, an additional 6.4 to 19.4 trillion in investment would be required, and a large part of that could be coming through green finance. But all of this for China happens in an environment where there are certain unusual characteristics, which is the complex regulatory framework with oversight from multiple regulatory authorities and jurisdictions, voluntary nature of certain green characteristics, deviations from international standards where more than 5% of your proceeds could either be targeted towards working capital or towards repayment of debt, certain non-standard green categories qualifying for funding by green finance. Till May, even clean coal was part of that category. Limited meaningful engagement from international investors, as a large part, more than 50% of the investment in green bonds in China actually happens from inside the country, domestic investors. And a perception that credit ratings for the green bonds are inflated, considering 95% of the Chinese green bonds receive AA and above rating versus comparatively only 6% of the green bonds issued by US are in that category in AA rating. And low liquidity in secondary markets and absence of a comprehensive overarching monetary reporting and verification procedure that allows to regularly and more coherently monitor how the proceeds are being utilized and the environmental footprint of these investments. Considering the important and significant role that green bonds could be playing in China over the course of the coming years, it is important to look into the productivity of green bonds in China. Are they efficient in actually promoting green? And what is the additionality that they are able to deliver for green? So can they deliver better terms, better financing terms, more financing, lower cost, or just longer tenor for debt for financing of green investments? Or are they able to deliver greater environmental integrity, greater environmental impact through green bonds? Or are we talking about helping some of those projects cross the line, which would otherwise not be able to be delivered or would have to wait for many more years to reach conclusion? On top of that, there are other factors that green bonds bring to the table, which is it's a useful engagement tool for greater number of parties. It's also a useful engagement tool for expanding the investor base for a number of clients, increasing green visibility, and building an understanding and consensus. But all of this would require that, one, we build a consensus around what green means, and two, we also measure whether the green is enough to actually be adding onto onto what normal non-green labeled bonds could be achieving on their own. So we put together this project with the ambition of considering how, excuse me, sorry, of with the ambition of examining the publicly available data to ascertain if green finance is actually being effective in China, and towards directing funds towards green and deepening its environmental impact, but also to see how far we can get with the publicly available information, considering the challenges of data. We set out a project here where, based on desktop analysis with a four-step approach, looking at hypotheses around the different important characteristics to be looking at for productivity of green finance, which we outlined in the last page. Market assessment versus green versus non-green green bonds in China based on labeling by third-party reviewers, identifying any advantageous trends, whether in the primary market or in the secondary market, taking it further down to sector and then issuer with regards to sample case study across each of the significant sectors that are dominating the market for green bonds issuance in China, to understand how effective has green bonds been in actually promoting green or promoting more sustainable investments. The main sources of data for our work has been FactSet and Wind. And on top of that, looking through corporate websites and issuance documents from various companies. And we have faced certain challenges while looking at the data, which is the lack of standard reporting framework and lack of transparency in certain aspects. Overall limited disclosure on the debt instruments across multiple databases, and minimal data available at the project level. Instead, a lot of the information, including environmental data and use of proceeds, are more at the bond level. And it has been, to some extent, challenging to find sufficient number of instruments where we could follow the full life cycle or to follow the full journey of the use of proceeds. But we've tried to make the best of with the information that we have been able to put together. Here you see a sample of from the literature review that we conducted, where a combination of global and China studies over the course of the last 3-4 years, where comparable green and non-green bonds were considered, matching their characteristics around maturity, around coupons, around yields. And so the key observations that we had was green bonds tend to show a marginal yield advantage. Liquidity advantages do exist, but depend on the type of investor, on issuer, and the certification of bonds. Multiple standards under which green bonds can be issued do sometimes tend to undermine the investor ability to effectively benchmark the bonds and to hence eventually price them as well. In certain cases, labeling of relatively standard pre-existing investments, such as working capital as green, also reduces the spread between the maximum and the minimum costs, rather than what we would have been able to observe for pure game-changing projects that some of this green financing could have been directed towards. Looking across the objectives and the framework at what we believe green finance should be able to deliver for the sustainability in China, we have narrowed down our thinking across 3 hypotheses. So the first question we asked was, are green bonds improving the terms and conditions for financing of green and sustainable projects? And based on a review of existing research, global green bond market, we arrived at the first hypothesis, which was there is no clear and obvious benefit in financing terms. When from our literature review, one of the key takeaways was, Matthias will share the link of the report towards the end. So one of the key takeaways was that in certain cases, there are advantages to the cost, but it is not fully carried through in all sectors or in all issuances. The second question we asked was, are green bonds encouraging more ambitious green projects and deepening of environmental integrity of projects? Here we noted that both green and non-green bonds with sufficiently similar characteristics for quantitative review is challenging. Environmental impact reporting within the Chinese green bond market raises further challenges, but we still wanted to look at the available information, the issuers that have disclosed their use of proceeds to follow through. And the second hypothesis was the China green bond market and its standards encourage greater environmental integrity of projects, which we go on to evaluate against a sample case study that we will look at later. And green bonds enabling projects that otherwise do not go ahead. On paper, we expect that green bonds should be able to make more projects fundable or be able to find the financing for otherwise later stage elements like energy efficiency or building costs. And we have noted that in certain cases, green financing has enabled these projects at a much larger scale than you would imagine. But so the third question leads us to our third hypothesis, which is the green bond market in China has encouraged a small amount of environmentally positive and sustainable projects to be implemented, which we would believe that otherwise would not go ahead. We now look to evaluate these three hypotheses through a quick market assessment in China and then looking at 3 case studies across 3 issuers. So, sorry. The green bond market in China on the type of bond is dominated largely by financial bonds, and and the next important category is enterprise bonds. On the issuer side, financial institutions are dominating the stage, with industrials and utilities the next important categories. The challenge or the characteristic for the market that this does create is that the financial institutions, many of them are issuing these bonds as intermediaries. So that creates another barrier in terms of cleanly following through the utilization of these proceeds and how all of the green funding is being allocated for the furthering of the sustainability agenda. Looking further under each of these categories, financial enterprise and ABS bonds have the highest proportion of green issuances. And in terms of sectors, financials, utilities, consumer, discretionary materials, and energy sectors dominate the green bond issuance. Looking further into the top sectors which are involved in issuing green bonds, we notice that green bonds typically show a lower cost than their non-green counterparts for some of the key categories. So financial bonds issued by financial institutions have shown a consistently lower cost across green bonds for most of the years. Similarly, we can see that enterprise bonds issued by industrials have shown lower costs across the years. We did not notice any standard advantages in terms of tenor for green debt instruments over non-green debt instruments. So financial institutions, financial bonds, yes. I mean, the green bonds issued were for even lower tenor than you had non-green bonds. Similarly, industrials, their issuances, especially enterprise bonds, were all for lower tenors, but corporate bonds were a mixed story. Similarly, corporate bonds issued by utilities have mixed story around the average tenors for which the bonds were issued. Enterprise and corporate bonds issued by industrials were also on the cheaper side in both the primary and secondary markets. And financials and utilities also showed cheaper costs for green bonds for most years. We also did not notice any significant impact of the green label from market assessment on the size of issuance in China. So green bonds typically weren't much larger in size than non-green bonds that could be issued by the same entities. We have looked at 3 case studies, one named each in industrials, utilities, and financial institutions. The selection of companies for the case studies was driven more by the availability of relevant information and disclosures on comparable instruments and use of proceeds, and also by the dominant sectors in which issuances have happened over the last few years, with some trends to show that at least certain financing terms could be better for the green sector. State Grid issued almost 10% of corporate and enterprise bonds that was issued between 2016 and 2019. Not surprisingly, given State Grid's significant role in the green bond market in 2016 when its bond was issued, our analysis of State Grid's cost of debt suggests there isn't a negative premium for green at issuance. So actually, green bonds were more expensive at issuance and continued to trade more expensively even in 2019. This result is overall in contrast to what we found from a market assessment where utilities have shown a small amount of cost advantage when it comes to green issuances. In terms of investors, almost 54% of the non-green bonds issued by State Grid were sold in the interbank market, with only about 7% to institutional investors and the rest to domestic legal people. And no green bonds were actually sold to institutional investors. So one of the characteristics for State Grid was that green bonds also did not open any new class of investors for them. The 2 green bonds issued by State Grid in 2016, again being 3-year and 5-year maturity, did not show any advantage in terms of tenor because of the green labeling. Now, following the use of proceeds from the State Grid issuances of the 10 billion raised by the 2016 bonds, half of it was applied towards working capital and the remaining towards ultra-high voltage projects. China's ultra-high voltage projects are part of the nation's strategy to shift electricity from west to east, where with the assumption that 1, it can drive the economy, but also 2, it can tap into more greener resources. For State Grid, which covers 88% of China's territory, we have been able to identify greenness of the investment through monitoring how much renewable energy is passed through some of the UHV lines. And we noticed that for one of the lines, no green energy was that was funded through this green finance, no green energy was being passed through. And through another of those lines, only 17% of total electricity transmitted was green. So State Grid did not actually, the issuance from State Grid did not actually add that much additionality or environmental integrity to by the issuance of the green bond. We looked at name under the industrial sector, looking at Swire Properties, which issued its first green bond in 2018 as part of its 2030 sustainable strategy. Now, there's one thing different about Swire, about this company's issuance, that they actually got certain certifications in place before they went ahead with their issuance. And by the end of 2018, sorry, excuse me. Because of the certifications obtained by Swire Properties on its green bond, a substantial portion of the bond was actually placed with institutional investors who were committed to green and sustainable financing, thus allowing Swire Properties through this green bond to actually tap into a new category of investors. The net proceeds from the bonds themselves were allocated to fund and refinance the company's new and existing green projects, including green buildings, energy efficiency projects, sustainable water and waste management projects around those buildings. And there was also focus, apart from the initial certification, there was also focus by Swire Properties to get certification on the buildings through the green building certification process within the tenor of the bond. So while Swire Properties did not actually see any advantage in terms of cost of the bond or in terms of the tenor of the bond for green versus its own non-green portfolio, they did bring additionality to the table through the issuance of the green bond. Looking at an example from the financial institution sector, the ICBC, which has issued 2 bonds across 2017 and 2018. Again, one of the key characteristics from ICBC's issuance was that they were actually able to get certifications under the Green Bond Framework as well as the HK's certification. And that actually allowed that actually allowed them to tap into a wide range of institutional investors, and help them to expand their investor base that they could bring in. Our analysis of their debt cost doesn't suggest that they were able to actually achieve any advantage in terms of costs. There weren't any significant advantage in terms of tenor, again, because these were 3 to 5 year bonds issuances. ICBC's green bonds are, by following the use of proceeds from ICBC, we were able to ascertain that their green bonds are classified under renewable energy generation, low carbon transport, and early development in marine renewable energy. And so their utilization of the funds from ICBC's issuances were actually able to forward the green agenda, to forward the sustainable agenda, and we also noticed that they were able to to fund projects which would otherwise not have immediately received funds, which is, for example, the initial funding for the marine renewable energy category. We will just look through, we are just going to consolidate what we've seen through in the last few slides to see if the hypotheses that we had put out at the beginning of the presentation still stand or not. I'm really sorry for my voice cracking, sorry. Hypothesis 1, testing our hypothesis 1, evaluating a portfolio of all AAA rated green bonds issued by China between 2016 and February 2019, we found 3 sectors dominated the issuances and observed the following trends. Green bonds were cheaper than non-green bonds for industrials, utilities, and financial institutions. Green bonds were also cheaper in the secondary markets for industrials and financial institutions. Utilities and financial institutions raised larger amounts on individual issuance when issuing green bonds. No clear trends were observed in bond tenor in green versus non-green. We also observed that other sectors such as energy, consumer discretionary, and materials gave inconclusive results across these 3 questions. Evaluating a sample of issuers, in this case, State Grid, Swire Properties, and ICBC, to check if the sectoral trends carry universally across the issuers, we observed the following. Green bonds were not cheaper than non-green bonds across each of the issuers. As each of the issuers had only 1 to 2 green bonds, it was not possible to ascertain the impact on the size of the issuance itself. And Swire Properties green bonds had tenor comparable to non-green bonds, but State Grid and ICBC had only 3 to 5 year bond issuances, which were, so they were technically lower than the non-green labels. So we persist with our hypothesis 1, which is there is no clear and obvious benefit in financing terms for green bonds over non-green bonds issued in China that we can establish from the publicly available information on its own. Testing for hypothesis 2 and 3, we noticed at State Grid that its green bond issuance proceeds was split 50-50 between ultra-high voltage and working capital, where the ultra-high voltage projects had less than a fifth of the infrastructure built serving green energy. So it would be incorrect to say that State Grid's green bonds did encourage additional environmental integrity or supported projects that would have otherwise not gone ahead. On the other hand, Swire Properties green bonds proceeds were utilized to fund green projects related to building development, energy efficiency, RE, sustainable water, waste, and climate change. Third-party verified green building certification was obtained, and we were able to reach the conclusion that Swire Properties green bonds did encourage additional environmental integrity. And they did encourage projects, especially in energy efficiency, which would not have otherwise gone ahead on the same time scale and on the same size if not for the green bonds. ICBC issuance represented a significant portion of the funding, of its own funding in 2017 and 2018. And ICBC had made concerted efforts to adapt international standards on green finance, and its bonds were classified for both renewable generation, low carbon transport, as well as certain early marine renewable generation. And from our analysis and review of the instruments, we are able to reach an early conclusion that ICBC green bonds did encourage additional environmental integrity of projects across generation and transportation. Especially low carbon transportation, railway in China, metro tunnels in Australia, and which would not have otherwise gone ahead on the same time frame and scale. So we do think that we can persist with hypothesis 2 and 3. However, we do want to highlight here also that we have one of the challenges that we faced was the limited amount of disclosure and limited amount of companies where we could actually follow the use of proceeds right into their implementation. So we would suggest a future project which includes wider engagements with issuers, investors, and in-country primary research through interviews and engagement. This would be essential to break through the barriers of the information paucity and also look beyond the multi-standard framework and the drivers of primarily domestic investor base, which requires a different level of disclosure. For the medium term, we would definitely recommend standardization of monetary reporting and verification to develop robust systems and standards that could be adapted through multi-regulatory setup, and measuring our attempt at looking through the green bond market in China to try and measure productivity was just a first step. But what we hope is that the framework and the hypotheses developed and some of the early look that we've had here would help set the parameters and the outline for a much wider, larger project, which is able to both assess the productivity of the entire green bond issuance that has happened over the last 3-4 years in China, but also incentivize issuers to more standardization and actually working with comparable standards and consistent reporting requirements to deliver the sustainability and green agenda for China. I would now like to hand over to David, who will talk you through deep green in China.
Great, thank you, Udetanshu. Let me bring up my so to begin with, these two reports here are actually two of four reports that were done by CPI. The first two, very much characterizing the green bond market in China, were discussed earlier in the year in the summer. The paper and the analysis that Udetanshu has put forward, very much characterizing and looking at the effectiveness of the green bonds and how we can use data to understand that, particularly through the case studies. But one of the things that we wanted to look at was really looking forward in terms of the opportunities for green finance. One of the areas that we have heard significantly about over the course of discussions, our wide discussions on green bonds over the last years, is the concept of deep green finance. That is moving from green bonds that are well, I'll actually move to the first slide here. Moving from green bonds that are just what we would call light green to ones that are actually transformational and leading to a new sustainable industry or economy or structure. So if we were to take the objectives of green finance, as you can see here, we're saying the first objective is to shift finance to investments in sustainable projects or activities. So very much along the lines of what we were talking about, to make sure that you have green projects, renewable energy projects, those energy efficiency projects and such. But the deep green view is can you use finance and investment to transform the economy to reach your long-term sustainability targets? And those are subtly different. So if we go forward and look at the focus of this paper on that second, the deep green area, we have some additional issues to address. First of all, before you can know whether the finance will lead to this transformation, you need to understand how do the issues of long-term sustainability differ from basic green finance. You need to understand, what does transform really mean? Begins to be getting in the territory of having a vision for what an industry and economy could look like. And then finally, the last thing we want to answer is, what types of finance options could be included in deep green finance, and how those might differ or in reality be the same. But what would you need to do to establish that your finance options are deep green rather than the lighter shade of green? So just a quick recap, really summarizing what Udetanshu was going into. The issues of green finance, and the first three papers really, the issues of green finance are, to some extent, verification to see whether the projects really are sustainable, whether that money is really flowing, as for instance in the case of State Grid. Did that investment flow exclusively to green projects, or did it actually go to projects that were part of the more brown economy? The other question is, does the investment reach the sustainable projects themselves? Again, talking about working capital, it's really hard to show that directly goes to the sustainable projects. The second area was around additionality. Had there not been a green finance market, would the project have gone ahead? Or alternatively, does the lower cost of capital for the project encourage policymakers and investors and businesses to substitute more green projects rather than brown projects because of the relative cost advantage? And so the analysis is hopeful, but I would characterize it perhaps as being not entirely conclusive yet, but moving in a hopeful direction. But the next thing we need to go in increasing shades of darker green is making sure that when we say, are those projects, verification, really sustainable, are we looking at the full cycle emissions? Not just the electric vehicles, but are we looking at where the electricity comes for those electric vehicles, or how the emissions in manufacturing can balance the equation? The second thing is, we need to then look at the behavioral impediments, the sustainability in particular. Would lower cost energy actually lead to a rebound effect that might negate some of the advantages of the green? But really, as we begin to look more importantly, are we, by financing certain projects, locking in existing industry structures, which might be good in the short term, but might lead to longer term problems? So, without significant changes in electricity markets, investing more in renewable energy might get you to a plateau that you can't integrate more electricity into the system because there isn't enough flexibility to integrate that renewable energy cost effectively. So perhaps when you start, and that's where we start beginning into 3, where you can begin to invest in flexibility in market systems and batteries, for instance, that enable you to integrate more renewable energy. That could in some ways be more transformational than investing in renewable energy that would otherwise be capped. So the things that we're looking when we get to really deep green are investigating how we can remove barriers to development of long-term sustainable systems, and those can both be the technical, like what I've discussed, or they may be policy and economic. And one of the things we'll show here is the risk that one of the barriers to transformation is the impact that a move away from coal, for instance, could have on local economies if there is not the finance and the transformation of the industries, the new industries and investment brought in to replace that and make sure that the economy continues to be robust. And so in some ways, you might lead slightly away from what would seem to be a renewable project if, for instance, a traditional renewable project, if what you're actually investing in is something that makes it more sustainable economically, so that it makes it easier to increase the scale of the move towards a fully sustainable system. In addition, then there's the development of new products and industry structures, business processes as well. So we need to be thinking beyond just the specific projects to how does the long-term system look, and how can this green finance actually lead us to a path that creates a fully sustainable system somewhere in the future. So the questions that you have there, we're beginning to border more rather than on is a project sustainable, but what is our sustainability vision? And so we have to understand what could or would the industry and economy look like, and what is the pathway. So we're beginning to say deep green finance has to help you lead down a pathway towards full sustainability. We need to understand what the barriers and catalysts will be to that vision. Then once we figure that vision out, then how can finance help overcome the barriers? And then what metrics, once we've looked at that, we need to begin to think about what metrics we should be using towards finance along the deeper green path. As you probably have noticed, 1 and 2 are going to be dependent upon specific industry and regional factors. That is to say, you need to, in this case, if you're looking for deeper green, you need to understand what the options and scenarios are for transforming the industry before you can decide whether or not that finance is in keeping. And so in some ways, there is a call that before you have deep green finance, to understand what the deep green finance is trying to achieve. Then once you do that, the understanding how finance can help or what metrics you need, those may be more universal. So what we have done is we have understanding that it all begins from specific industry and regional factors. We studied 2 contrasting provinces, Shanxi and Sichuan, and their energy industries, to begin to understand what visions might look like, or how, or what the path at least might look like, and therefore begin to help us develop answers around 3 and 4. For this project, we spent a significant amount of time in both regions, meeting with the DRCs and with the financial industries and the energy industries around there, to understand what some of the problems and solutions might be to get to a very, very significant transformation towards a sustainable economy. And it is very instructive, it is very instructive to use these 2 provinces, because they are at some ends on opposite ends of the pole in terms of where they stand in terms of the issues. Some data on these to begin with. Shanxi province is a relatively small province by Chinese standards, 37 million people, the 18th versus Sichuan, one of the largest ones with 80 million. Both of these provinces have below average GDP per capita. Shanxi is one of the poorest, where Sichuan is just below average. Interestingly, their overall electricity demand is pretty similar, despite the fact that Sichuan is double the size of Shanxi in population, and that is climate, but more the higher industrialization of Shanxi. In terms of carbon emissions, Shanxi has the third highest carbon emissions per capita in China, while Sichuan has the second lowest. And that's mainly because the electricity system is driven almost entirely by hydro, whereas Shanxi actually is one of the largest wind and solar producers in the country, but is also the center of the Chinese coal industry, along with Inner Mongolia. Shanxi has a quarter of Chinese coal production and mining, with just 3% of the population. We looked at this and found that about 20% of the GDP of China comes directly from coal mining. But when you look at the multipliers and the indirect ties, both the employment, but also industries like steel and coke and power generation and chemicals industries, as well as the services to support, it could be 60 to 80% of the economy is actually driven by coal in Shanxi. They have the largest coke industry, a big steel industry, power generation where they export significant amounts of power, chemicals industry based on coal. All of these exist because of the use of coal as a strategic low-cost resource. And so for Shanxi, coal is the very heart of the economy, whereas in Sichuan, given the hydro, the fossil fuel are relatively unimportant, a very, very small portion of the economy. Where that leads us to are different sets of sustainability transition issues. In Shanxi, the question is, how can you replace industries such as mining or steel, be replaced and made more sustainable? Again, a big policy barrier for China would be if Shanxi province no longer had coal, what happens to the livelihoods of 37 million people? And if I'm a policymaker, one of the things I need to do in this transformation is to understand how we can manage our way out of that problem effectively, and while continuing to grow Shanxi so they can reach Chinese average levels of income. The second question is, if you are to replace these industries in Shanxi, what can you use where their leverage for these industries has now been based on access to inexpensive coal? There's a question about how much time Shanxi has to make the transition, and then what support does Shanxi need, and how does that support fit within the wider Chinese context? So for Shanxi, the question is not just how we transfer out of coal, but how do we make sure that in the transformation to reduce the coal footprint of Shanxi, that the economy and the people in the country are not devastated by the economic impact. Sichuan has actually a completely different problem. Sichuan has a significant amount of hydroelectric resources that our analysis and evaluation showed are significantly underutilized in terms of their ability to help manage increased renewable energy elsewhere in the system. That is to say, there's a significant amount of flexibility in the use of hydro from Sichuan that could help China integrate more renewable energy outside of Sichuan cost effectively. And so here the issue is more, how can Sichuan benefit from resources that it has that could help the transformation of China in general? So two very, very different perspectives, but ones that I think really help us begin to think about the range of transformational finance that could happen through a green finance market. So, what are the opportunities? There's a lot that needs to go beyond this, but one of the things that we began to look at are what are the clear opportunities in both Shanxi and Sichuan that lead to greater sustainability. The first issue is Shanxi has a significant amount of power where they export power to places like Beijing through the transmission line and such. Those power plants can be made much more flexible. And so there what you have is a situation where you could run a power plant, let's say 20% of the year, to provide backup to renewable energy power, or 20% of the time over the year to back up cleaner power, renewable energy, for instance. You therefore reduce your carbon emissions substantially, but you still provide value from those power plants. And in fact, in analyses we've done in other countries, we've shown that as you increase renewable energy in systems, the value of, in one study we did, we saw that the value of coal-fired power plants at 20% load factor on a highly renewable system with the appropriate market mechanisms, incentives to be flexible, those power plants were just as valuable as the power plants running 80% of the time, because they were producing when the energy was most needed by providing backup services. To do this, you will need to invest in the power plants, to make them more flexible, and invest in the mechanisms to make sure that you can actually price or value that. However, all that does is it saves the power plants. You are still reducing the amount of coal mining that you would have, and so that's just the beginning of one solution. The second part of it is developing carbon capture and sequestration for power generation. In general, around the world, CCS for power generation has lost most of its glitter from the last 15 or 20 years, as renewable energy has now become significantly less expensive, even than, in many cases, in most cases, than coal-fired power generation, even without CCS. So adding CCS, which reduces the efficiency and increases the costs, is a non-starter in many markets. That, however, is a case where you're not looking at the needs for an economic transition or transformation such as Shanxi. In this particular case, it looks like with CCS, you could create the opportunity to extend the life of the coal in a more sustainable basis to buy you time to make the transition out of coal. And so if you're looking at where CCS might make sense in the world, Shanxi province is one of the few places where it actually seems to make a significant amount of sense. Because of the ability to use it, if you can get that quickly in the next few years, if you can get CCS really built up and scaled up, it allows you to buy time to transition the state towards a more sustainable future. So it's about a transition, but it's one where you're using this to maintain employment as you do the transition and to buy some time. And when you combine that with the flexibility, you're beginning to have a balance between plant retirements, repurposing for flexibility, and adding CCS to some of the plants to begin to develop a transition pathway. The third one is, once you have CCS in place, then some of the industries such as chemicals, coking, and steel can also benefit from the CCS infrastructure to become sustainable in a transition. Again, the long-term position around steel is likely to be won by replacing metallurgical coal with hydrogen. Our analysis is all pointing to that. So this may be a temporary fix, but it will take 20 to 30 years at least for that transformation to be complete. So again, you are buying time within the constructs of that to enable Shanxi to exploit the coal resources with a reduced and more sustainable impact while we're making a transition to a net zero economy for Shanxi and China more widely. So those are the sorts of things that we would be looking at to be deep green finance in Shanxi. When we're looking in Sichuan, recall that the issue here was to get greater access to the flexibility potential within Sichuan. We have worked with both Sichuan University and Dadu Hydro and others in Sichuan to understand that there are further opportunities to expand the flexibility in the hydroelectric system there. However, it will require better transmission capacity, both to near provincial neighbors, but actually further afield, so that you can, and transmission that will be designed not around bulk electricity supply, but around offering flexibility back up to renewables elsewhere in the system. The second, to do that, you need to be able to understand what the value of that hydro is. So there's better measurement, metering, planning systems, so that you can have incentives to show exactly when you should be using that hydro and how do you optimize production to lead to that sustainability path and enhance value. And our analysis is showing that there's likely to be significant upside in the value of Sichuan hydro if it can be dispatched appropriately. You get all sorts of benefits as well, like reduced. You'll improve the efficiency of the remaining coal fleet by reducing startups and stops. If you can use the flexibility of that instead, having longer downtimes for some of the coal, there's a significant advantage across the entire system in the short term, as well as in the long term, as it enables higher levels of renewable energy with a secure system. And so there are some enhancements to the hydroelectric capacity that will need to be made, some investments in those, and really the long-term development of markets and incentives that really help manage these combined resources of hydro, wind, solar, demand management, and other sources. So there's a significant advantage there, but one that requires investment in both transmission, but more importantly, systems that enable us to evaluate the most appropriate and efficient use of the energy resources of Sichuan to help China transform its overall electricity production system. So when you pull these back together, we wanted to look at these sorts of examples, these sorts of activities. What does this mean for finance? And it really does begin to come back on the sorts of finance we've already seen in green markets, both in equity and in debt, but with a slight difference. And the difference being is first understanding the vision of what the overall green is. What is the green plan for the area? And then how can this be verified and additional in terms of leading to investments in those activities that are going to pursue the path, are going to push us down the path towards a fully sustainable system. So, it is clearly investment in CCS and power and industry in Shanxi. That needs research and development funding with all the contingent problems or issues around de-risking and blended finance and R&D support that are incumbent upon that. But in reality, huge opportunity there if we can get the policy supporting the green finance right. There is technology deployment and scale up for manufacturing, in terms of building support equipment. That could be renewable energy manufacturing, but it could equally be batteries or manufacturing of upgrades for the coal-fired power plants to increase flexibility. There is the deployment and scale up of equipment that we already know about. That's not too different from what we have already seen, except for now that we have to understand how those upgrades fit within the long-term vision. Supporting infrastructure, but the difference here, again, using the state grid case, is making sure that the transmission that is incorporated in this is, in keeping with the specific long-term sustainability plan, for instance, in the case of Sichuan, to enable the increased flexibility of the system. There is development of regulation and markets and concepts, which will also require funding, particularly not just from the policy perspective, but in order developing the systems. One of the things that we think is a real potential need is this phase out, the risk management phase out of existing assets. And so this is about the finance of, for instance, at the Shanxi province level, of the retirement and repurposing of existing assets. So transition funding that is helping a province like Shanxi lead towards a new sustainable industrial path. There can be long-term hedging and transition assistance, but also finally leading into the retraining and personnel and development of new industries, investing in new industries, that is also helping in the transition funding. So there's a whole raft of potential financing opportunities, but the key here is really understanding what those transition paths look like at the provincial level as well as at the industry specific level. We have taken those two, electricity industries or energy industries in those two provinces, and they really are quite revealing about what the long-term potential could be around deep green finance once we begin to work down that path. I will, with that, wrap up this one and leave it over what's left. Not much time left, but leave that open for questions.
Thank you very much, David. We did have one question from Ken Deitel, which Udetanshu has answered on the China side. But David, I wondered if, I know you've just been speaking for a while, but if you wouldn't mind reflecting on perhaps the UK and other regions. So the question is, I don't know if you can see it in the box there at the bottom. This report relates to historic data, but more recently there has been significant political support and public awareness for green initiatives both in China and the UK. Is it fair to say that green bonds coming to the market now will have not only greater investor interest, but a higher caliber of green sustainable projects to invest in? So there have been, a number of initiatives, a lot of activity in this area. Most recently, the UK government announced that it would launch the UK's first ever green sovereign bond, for example. But David, some reflections on that.
I think that's the case. Some of the problems that we have seen in the early phases of green bonds, which is, money going into businesses and then you not being able to trace it, I think have significantly diminished. There's been better reporting, and we even saw that within the issuances that Udetanshu was looking at. I still get the feeling that the issuances, it's often hard to tell whether or not a company is segregating their investment plan between that's green and that's not green, and then dedicating all the green stuff to the green portfolio and using the standard channels for the brown. That one, I don't think we've really bottomed out whether or not green is truly additional from that perspective, or it's just a way of reallocating. I think we're getting a little bit better on that, and I think it's all early days even now. Obviously not as early as it was 2 or 3 years ago, but we don't have the full data on the stuff that's coming now. In terms of moving towards deep green finance, what my hope is that we really begin to address the issues of, can we think about this within the context of the net zero plans, the transition plans we have, and how this actually helps us reach those goals. I don't feel that more holistic approach to what really is a transformational green has taken hold yet. But I'm hopeful that that's coming, because I hear there is a lot of discussion about what deep green will be and what it means and how you would regulate it and move it forward. And I think that taking these sorts of examples that we have can help us make take the next step. And of course, the announcements of net zero targets in many jurisdictions in China and elsewhere really begin to force, I would say, the examples that we're talking about here to look at that transformation. And one of the things that is also has been quite revealing about the net zero targets is the extent to which if we only get to net zero targets by 2050, if we continue at current emissions, our numbers show that if China were to continue at current emissions to 2050 and then overnight go to zero, that China itself would consume all of the carbon budget the world has to stay under 2 degrees C. So the net zero targets are great, but the transformation, the ability to begin to make near-term movements quickly is very, very important. So the green finance needs to be more redirected towards the, first of all, can we get to that long-term sustainability path, but also how can we facilitate the acceleration of that path in the short to medium term?
Great, thank you, David. If there are no further questions, then I think we should wrap up now. Feel free to reach out to us following this session, obviously. Yeah, that leaves me just to say thank you very much for your time and interest in our work. And yeah, enjoy the rest of your day or evening, depending on where you are. Many thanks.
Thank you.
Thank you.